Let me give you a number. Depending on how you define the market, chiropractic generates somewhere between $8 and $14 billion annually in the United States. Globally, the number sits north of 19 billion. That range isn't imprecision, it's a signal. Nobody has bothered to measure this category consistently because nobody took it seriously enough to try, and that tells you everything about where institutional attention has been. There are over 70,000 licensed chiropractors in the United States. They treat approximately 35 million patients every year, and yet almost no institutional capital has touched this space. No major PE roll ups, no publicly traded pure plays, no category defining platforms. That's not a sign that the opportunity isn't there. That's the opportunity. Most people dramatically underestimate how large chiropractic actually is. When you say chiropractic in a boardroom, people think about a small storefront practice, one doctor, a couple of tables, a handful of patients a week. That mental model is wrong, and it's costing investors a legitimate opportunity. Chiropractic is the third largest primary healthcare profession in the United States behind medicine and dentistry. And unlike most healthcare professions at this scale, the overwhelming majority of chiropractic practices are independently owned. That level of fragmentation is rare. And in the context of consolidation, it's exactly what makes a category interesting. Demand is not the problem. Utilization has grown steadily for 2 decades. The clinical evidence base for MSK conditions continues to expand. And as the opioid crisis reshaped how patients and providers think about pain management, chiropractic gained significant clinical and cultural tailwind. The market is large, the demand is real, the growth trajectory is there. What's missing is the infrastructure to capture it at scale. When institutional investors evaluate a healthcare category, they run through a standard checklist. Proven demand, yes. Recurring patient relationships, yes. Relatively low capital requirements per location, yes. Fragmented ownership, meaning room to consolidate, yes. Favorable demographic tailwinds, yes. Chiropractic checks most of the boxes. So why hasn't capital moved in? Three friction points, and it's worth addressing each one directly because none of them are permanent. The first is perception. Some institutional investors still mentally file chiropractic alongside fringe wellness rather than legitimate healthcare. That perception is outdated. The American College of Physicians recommends spinal manipulation as a first line treatment for low back pain. Major health systems are integrating chiropractic, but data moves slower than narrative in finance, and changing perception is work that has to be done deliberately. The second is payer mix and market visibility. This is where the standard investor playbook gets it wrong in two ways. When a PE analyst runs a quick screen on chiropractic, they're pulling the most conservative market sizing figure available, the one that counts only direct clinical revenue from chiropractic offices. They see a sub $10 billion market and move on. What they're not seeing is the broader revenue stack, the ancillary services, the wellness spend, the care plan economics layered on top of the same patient relationship. That revenue exists. It just isn't being captured or reported in a way that maps to how investors model healthcare sectors. So they're not just undervaluing chiropractic, they're undervaluing it based on incomplete data. The gap between perceived opportunity and actual opportunity is wider than the headline number suggests. The second part of this friction point is recession sensitivity. Investors are trained to flag cash pay dominance as a risk, and that deserves a direct answer. Chiropractic demand sits on a spectrum. On one end, acute pain, post injury recovery, workers' comp, chronic MSK conditions. That care is not discretionary. Back pain doesn't pause for a recession. On the other end, maintenance visits, wellness adjustments, preventive care. That is more elective, and it does compress when patients feel financial pressure. Where a specific practice sits on that spectrum depends entirely on how it's built, its patient mix, its revenue model, its care plan structure. A practice built around acute and chronic care with proper payer integration has demand characteristics that look much more like essential healthcare than a day spa. The investor objection isn't wrong. It's being applied to the wrong model. Practices built correctly with structured care plans, recurring revenue, and the right mix of acute and maintenance care behave more like subscriptions than discretionary services. That is an infrastructure and positioning argument, not a category flaw. The third friction point is operator sophistication. Chiropractors weren't trained to speak the language of EBITDA, platform multiples, or enterprise value. Most were trained to treat patients, and they've built their businesses accordingly. That creates friction in deal structuring, but this isn't permanent. It's a function of education and infrastructure. All three of these friction points point to the same root cause. The infrastructure to make this category legible to capital doesn't fully exist yet. That's the problem this channel is built to address. Here's the core problem, stated plainly. Most chiropractic practices were built to treat patients. They were not built to be acquired, scaled, or operated as part of a larger platform. No standardized operating model, inconsistent documentation, financial statements that don't map cleanly to what a buyer needs to underwrite a deal, no reproducible growth playbook. When a PE fund acquires a practice, they're not buying revenue, they're buying a system, something they can replicate 50 or 100 times and extract predictable returns from. If the system doesn't exist, there's no deal. That's the gap. And it's worth being clear about what closes it, not capital and not intent. Infrastructure, the kind of integrated operating infrastructure that standardizes workflows, automates revenue cycle, tracks the right metrics, and creates the clean, scalable unit economics that make a platform investable. That infrastructure doesn't fully exist yet in chiropractic. That's both the problem and the opportunity. The practices that build on it first will be positioned differently, not just as businesses, but as acquisition targets, as platform anchors, as the foundation for the kind of roll-up strategies that have already transformed every other fragmented healthcare sector. Let me make the timing argument directly because it matters. Every healthcare sector that has undergone consolidation, dental, dermatology, ophthalmology, urgent care, behavioral health, went through the same sequence: fragmented, owner operated market, capital light, under leveraged. Then the right infrastructure arrived, platforms emerged, PE discovered the category, multiples expanded, consolidation accelerated, and then the window closed. Ownership moved upstream. The early movers captured most of the value. Everyone else sold at a discount or got left out entirely. Chiropractic is early in that sequence. The infrastructure is being built now. The capital is starting to pay attention. The roll-up strategies are forming, but the market is still overwhelmingly fragmented. Over 90% of practices are still independently owned. That means the window is open. It won't stay open indefinitely. For investors, the category is large enough to matter, early enough to move, and fragmented enough to consolidate. That combination is rare. For chiropractors, the question is not whether consolidation is coming. It is. The question is whether you're positioned to participate in it on your terms or watch it happen to you. So, what does it actually look like when the infrastructure gap gets closed? A few things happen simultaneously. Practices become legible to capital, clean financials, standardized workflows, documented growth systems, the kind of operational profile that makes due diligence straightforward and deal structuring efficient. Unit economics improve, not just because of cost reduction, but because the right platform connects patient acquisition, conversion, retention, and monetization into a single operating loop. Revenue per patient goes up, overhead per location goes down, the model scales, and the investment thesis becomes undeniable. A fragmented sector, proven demand, favorable reimbursement dynamics relative to other healthcare categories, demographic tailwinds, and a scalable operating model. That's the pitch. Chiropractic is one of the most underleveraged healthcare investment opportunities in the world. Not because the demand isn't there, it is. Not because the clinical case isn't there, it is. Not because the market isn't large enough, it is. The gap is infrastructure. And infrastructure gaps in healthcare don't stay open forever. That is the definition of an early stage opportunity in a late stage industry. The next few years will determine who captures that value and who watches from the sidelines while someone else does. If you're building in this space as an operator, as an investor, as a platform, you're in the right place. This channel is going to cover every dimension of this conversation: the capital side, the operator side, the infrastructure side, the exit side. Subscribe if that's the conversation you want to be part of. I'm Dr. Brian Capra. I'll see you in the next one.